Imagine waking up tomorrow to find that one of the world's biggest silver reserves is quietly disappearing. And no one, not even the US Navy, can stop it. A single land route has been activated, connecting China and Russia in a way that could silently drain Russia's silver stockpiles, reshaping global markets before most of us even notice. This isn't some conspiracy theory or sci-fi plot. It's happening right now, and the implications could ripple across currencies, commodities, and even your retirement portfolio. The story begins with Russia. Once a giant in the global silver market, Moscow has long relied on exporting precious metals to fund its economy. Silver, often overshadowed by gold, has suddenly become a strategic commodity. But geopolitical pressure, sanctions, and economic isolation have complicated traditional shipping routes. For years, Russia depended on maritime exports, a domain carefully monitored by the US Navy and allied forces. Yet, what happens when the sea isn't the only highway? China, ever patient and strategic, has quietly been building infrastructure that bypasses these maritime choke points. Rail networks, road corridors, and specially designed logistics hubs now connect Chinese markets directly to Russia's silver mines. What this land route accomplishes is astonishing. It allows tons of silver to move discreetly across borders, away from prying eyes, tariffs, and naval blockades. For context, while the world's attention focuses on ports and shipping lanes, a train or convoy can move an equivalent volume in days with minimal scrutiny. But why silver? Why now? China is preparing for what many analysts call a strategic commodity race. With global inflation, monetary uncertainty, and the unpredictable trajectory of the US dollar, silver isn't just an industrial metal. It's a hedge, a safeguard, and increasingly a weapon in economic strategy. By securing Russian silver overland, China is not just buying metal, it's quietly strengthening its financial leverage against the West, creating a hidden buffer that most investors don't even know exists. Meanwhile, the US Navy, traditionally the global enforcer of maritime trade dominance, finds itself largely irrelevant here. Naval power can monitor oceans, intercept ships, and enforce sanctions, but a well-planned rail or road operation? That's a blind spot. The land route doesn't require ports, it doesn't attract satellite surveillance the same way a freighter does, and it sidesteps sanctions that are maritime focused. In essence, an entire segment of global trade is operating in a zone where naval might can't touch it. The scale is staggering. Estimates suggest hundreds of tons of silver could move this way every month. That's enough to influence global silver prices, disrupt industrial supply chains, and potentially undermine the dollar's dominance in commodity trading. Investors, both retail and institutional, rarely track these land-based flows. They watch futures, ETFs, and official export numbers, but this route is largely invisible until the effects hit markets. And when they do, it could be sudden and severe, catching many by surprise. The strategic implications extend beyond finance. By diverting silver overland, China not only secures a critical resource, but also challenges the very perception of US naval superiority. For decades, dominance at sea meant dominance in trade, influence, and enforcement. Now, a combination of geography, infrastructure, and economic foresight is quietly rewriting that equation. The question becomes, if the world's largest navy can't control the flow of silver, what other critical materials could follow the same path? Rare earths, energy resources, even food commodities, anything with value that moves across borders could soon bypass traditional Western oversight, and yet very few are paying attention. Most headlines focus on flashy military exercises, diplomatic disputes, or stock market swings. The reality is far subtler, far more dangerous for those unprepared. Russia's silver isn't just a number on a ledger, it's a lifeline for Beijing's economic strategy. Every ton that crosses overland adds another layer of leverage, another bargaining chip, another silent pressure point against global markets and the US dollar's perceived stability. Stability in global silver markets has always been delicate, but what's happening now pushes it to a new level of vulnerability. Imagine supply chains stretched thin, industrial demand rising, and suddenly a massive inflow of Russian silver lands in China, quietly, efficiently, and almost invisible to the world. Prices could swing unexpectedly, and those who rely on silver for electronics, solar panels, or even investment portfolios could find themselves reacting to shifts they never saw coming. The mechanics of this land route are surprisingly simple yet highly effective. High-capacity trains, specialized cargo trucks, and even secure convoys through remote border regions allow continuous transport with minimal bottlenecks. Unlike shipping, which faces storms, piracy, and naval inspection, land transport is faster, more flexible, and harder to monitor. Intelligence sources suggest that Chinese logistics companies have been preparing for this scenario for years, investing in infrastructure and creating dedicated networks designed to maximize efficiency and secrecy. For Russia, this arrangement is a strategic win as well. Sanctions have crippled many conventional export avenues, but now silver can leave the country without triggering international alarms. It's a subtle yet powerful way to generate revenue, strengthen alliances, and maintain economic momentum in the face of global pressure. The combination of necessity and opportunity has created a perfect storm where both nations benefit, while the traditional Western monitoring mechanisms are effectively bypassed. But what does this mean for the US and its allies? The immediate answer is a loss of control. Naval dominance has been the backbone of Western influence over global trade for decades. But as this land corridor proves, control is only as strong as your ability to monitor every route. When an entire segment of the commodity market moves outside of maritime oversight, traditional levers, like sanctions, blockades, or inspections, become largely irrelevant. It forces a rethink. Naval power is no longer the catch-all solution for global economic enforcement. Investors watching silver should take note, because the consequences are tangible. Spot prices may remain stable temporarily, but underground flows can create sudden volatility. Industrial consumers could face shortages or price spikes. Even hedge funds and large commodity traders may be blindsided if this land route suddenly channels a massive volume of metal into China, changing demand-supply dynamics before official statistics even reflect it. In short, the market is moving in a way that few are positioned to understand or respond to quickly. Moreover, there's a geopolitical layer that can't be ignored. Every ton of silver that crosses this corridor reinforces China's strategic posture, while subtly undermining US influence. It's a quiet challenge, almost invisible to the casual observer, but its impact can ripple across multiple fronts: financial, industrial, and diplomatic. For a world reliant on the illusion of control over global resources, this shift is both sobering and unprecedented. The question now becomes, can the US and its allies adapt? Intelligence agencies can track infrastructure, satellites can monitor convoys, but acting decisively against such flows without triggering a broader conflict is a delicate dance. Any aggressive attempt could escalate into a major geopolitical crisis, yet ignoring it could have lasting economic repercussions. The invisible hand of this land route is reshaping power dynamics without firing a single shot, and that's precisely what makes it so dangerous and effective. Effective strategies often hide in plain sight, and this land route is a textbook example. While the world focuses on flashy naval exercises, trade sanctions, and diplomatic posturing, the real game is being played quietly on the ground, mile by mile, ton by ton. By the time most people realize what's happening, the consequences will already be embedded in commodity prices, industrial supply chains, and national reserves. This route doesn't just move silver, it moves leverage. China gains bargaining power, Russia gains revenue, and both nations effectively sidestep Western control. It's a subtle, almost surgical reshaping of global economic influence. The silver flowing through this corridor could quietly affect everything from the cost of electronics and medical equipment to the pricing of investment-grade metals. And because it's happening overland, it avoids the public scrutiny and political backlash that maritime trade often invites. In other words, it's invisible power at work. Financial markets rarely reward foresight when it comes to these invisible shifts, but those who understand the implications stand to benefit, or at least protect themselves. Historically, sudden shifts in supply chains, especially in commodities like silver, have triggered rapid price swings and investment realignments. The difference here is that the catalyst is neither a market panic nor a political scandal. It's a logistical innovation, a land-based strategy that quietly changes the rules of engagement. And while some might dismiss silver as just another metal, that's a dangerous oversight. Industrial demand continues to grow, central banks still hold reserves, and global investors increasingly view silver as a hedge against inflation and currency risk. When a major supplier like Russia channels its silver straight into the hands of China without maritime oversight, it subtly but profoundly alters the market balance. Suddenly, the West's perception of control over precious metals is not just challenged, it's undermined. The broader lesson here is clear. Power is no longer solely about visibility or strength. It's about adaptability, foresight, and the ability to operate in the shadows where traditional enforcement can't reach. China and Russia have turned necessity into opportunity, transforming logistical ingenuity into a strategic asset. And the US, despite its unmatched naval might, is learning that even dominance has blind spots. blind spots that can quietly shift global economic leverage in ways most investors and policymakers aren't prepared for. The question now isn't just about silver. It's about how global trade, resource control, and economic power are evolving. The rules are changing, silently and inexorably, and those who recognize it first will have the advantage. The land route isn't just a supply line. It's a symbol of a new era where traditional power structures are being quietly, efficiently, and effectively rewritten. In conclusion, the activation of this China-Russia land corridor isn't merely a logistical development. It's a wake-up call. It exposes vulnerabilities in old assumptions, challenges traditional naval dominance, and reshapes how we think about global commodity markets. For investors, policymakers, and anyone watching the interplay of resources and power, it's a moment that demands attention, IC thinking, and perhaps a reevaluation of what control truly means in a rapidly shifting world.